Okay. I got an interesting question. Hi, Joseph. James, is there a link I can use to get the latest final hour presentation? Does that mean that you want the script or something like that? Because these final hours are all archived right on my YouTube channel. So maybe you can clarify that. How you doing, friends? This is Coach Ernie, and this is the Final Hour Show. And today we're going to talk about how to avoid busting an account. So I know that a lot of people, when they're first starting out with a strategy, they want to go into it light and know exactly what they're up against and what is the risk of ruin. Now, what is risk of ruin? Risk of ruin is the level in your account that, given the amount of capital that you have and the chances that you incur. I'm babbling. But let's say you trade this for a year for that amount of money. Over the course of that year, given all the ups and downs, the expectations, the expected profit, the expected loss, what are the chances that you're going to bust that account or go to zero or go to some level that you would consider a total failure? So, for instance, if I drew down an account and brought it down 50%, I would definitely consider that a total failure. But if you're starting with a very small account, maybe $2,000, $3,000, $4,000, you want to know, well, what are the odds that if I employ this strategy, that I'm going to wipe it out, right? And if I don't wipe it out, that means that I'm going to, at the very least, have some profit to it. And then what are the odds that I will actually gain from that strategy? So I did exactly that. We take all of our strategies and we put it through the rigor of a Monte Carlo analysis and some backtesting, although backtesting on discretionary options trading is not the easiest thing to do. And it probably doesn't have a great deal of value because it's kind of assuming that you're a computer, and we know that we're not. However, if you follow our strategies, we have various different strategies, and I've categorized them all. So and they're all categorized by the amount of time that you're in the trade. So the shortest duration is a single day or a 0 DTE trade. And we call that the 0 DTE tactical. The next length trade. Oh, and by the way, the 0 DTE tactical can actually go up to 2 days. In fact, in markets like what we have right now, because the volatility is so low, and because we have accelerated premium decay, and a lot of the moves that actually happen overnight, that kind of takes away some of our edge of collecting premium and directional advantage. So we find that by going out a day, sometimes 2 days, when the VIX is very low, that recaptures that edge. So that's the 0 DTE, which is actually 0 to 2 DTE. And then the next campaign we call convex stack. That's where we start switching from the very active part of trading, day trading in a 0 DTE account, to something that's a little bit more passive, but still maintaining a lot of the same constructs that we used in 0 DTE, like volume profile and the level of the VIX and sizing your account and so forth. But we're pushing things much further out. I'm just explaining what the strategies are. Then we go to a slightly longer DTE that is 5 to 10 days. We call that a sigma drift. So those three strategies and all their edge case strategies comprise most of the strategies that I trade, and also people in my coaching service. They trade these three strategies, and they're all based on the amount of time that you have in the market. So, for example, last week, volatility was super low, in the 14s. Can you believe it? And so, doing a 0 DTE trade is really difficult in that kind of environment. So you might opt for something a little bit different, or like a time warp, which is also part of the 0 DTE family of trades, but you go out 1 day or 2 days. So that gives you a little bit more room. But then we also pick up the convex and the sigma drift campaign because we knew that the following week, this week, there may be some fallout from various things like the Jackson Hole meetings and, with the Fed and all. And also the Russia-Ukraine talks, which were held on Friday, but we were expecting some kind of result this week. So far, nothing. In fact, today, just looking at the market, you'll see that we are just so tight in there. I mean, I don't think the market has moved up or down more than 10 or 12 points. Kind of hard to make money when the market only moves 10 or 12 points. However, if the overnight move included about 25 points plus that 10 or 12 points, and you capture that length of time, now you've got something, you see? That's why you would move out in time as volatility goes down for the 0 DTE trade. Now, I'm getting off track a little bit here, but I want to let you know that each one of these trades, we understand approximately how much money that we have to commit to a 0 DTE campaign that we run month by month, or for an entire year, or a convex stack, or a sigma drift. Sigma drift is the one that I'm going to focus on right now. So I know exactly how I'm going to trade a sigma drift campaign. And I know exactly how much money I'm going to invest in it. So, and I'll explain that. So a sigma drift campaign is putting trades on 5 to 10 days out. And that would be perfect for this type of situation where last week we're trying to put on trades for the following week or this week. Trying to capture any move that happens with the Russia talks or the Jackson Hole conference. Now, we don't know whether the market's going to go up or down, so what we do is we put a butterfly trade above and below the market 5 to 10 days out. And then we layer them and just sort of stagger them, like one on Monday, Wednesday, and Friday. And so by doing that, if something does prop up, there's a very good chance that we're going to capture it in one of those trades. And by doing that also, the return on those types of trades is really phenomenal. We're risking extremely small amounts for these, typically around $50 to $70 per trade, but they have a return as much as $4,900, sometimes more, $4,900 or more for that small trade. So what we're doing is we're planting small seeds to make big return. Now, we're not expecting to make the jackpot. However, if there is any move towards our strategy, we can make somewhere along the spectrum of those results. And typically that could be anywhere from, several $100s to a few $1,000s. So we know that these things are going to happen. And we also know exactly how much we're going to risk over the course of a year, because the Sigma Drift campaign has a very specific investment schedule. So you put on one trade a week on any day that you choose. You can, but we recommend keeping it regular. Let's say on Wednesdays, and you do an 8 or 9 DTE or 7 or 5, whatever you want. And then so that's 4 trades a month. And then you do 2 discretionary trades. We call them floater trades. And those are really used to position for big events that you see coming up, like a Jackson Hole or whatever. And so that means that every month you're going to put on about 6 trades. Now, over the course of a year, that ends up being a little over 70 trades. So if we know that we're paying around $50 to $70 for these trades, now we know exactly how much we're going to commit over the course of a year. So if you have a small account, let's say a few $1,000, $5,000, $3,000, $5,000, whatever it is, and you wanted to trade something like this, and this is like perfect for a small account, by the way, because you're not really super active. You put the trades on, that's a very passive, it's an active thing, but it's really a no-brainer thing when you're putting them on. And then you're waiting for kind of an explosion somewhere along the line. And when that happens, you harvest the profits. Now, if we were to look at what that looks like, then we can do a Monte Carlo analysis and do a simulation where we go through 10,000 of those events, like you lived for 10,000 years and every year you traded this thing the same way. What would happen? And then from that, we can figure out if I started with $1,000, $2,000, $3, $4, $5, what are the odds that in those 10,000 runs that I would go to zero? Actually, the simulation I did was 5,000 runs. What are the odds that I would go to zero? Right? So that would tell you then, hey, if I've got a $3,000 account and I trade this campaign, what are the odds that I'm going to go to zero by trading this? And what are the odds that I'm going to make big bucks? Right? Because you could typically come out of this making, I don't know, as much as 600% of your original capital. So, or 6 times. So in other words, a $3,000 account might turn into $18,000. So you want to know, what are the odds of me not losing and potentially winning? And this is probably the best way to build a small account. So we do this type of analysis, not only on the Sigma Drift, but all of our campaigns. In all of them, we have an idea of what we're willing to commit, and it will tell us how much trading capital we need and what our expectations are and so forth. So perhaps I can then show you that. But before I do, let's see, there's a couple more questions. Phil, the sound is messed up. There is no EXO? Never mind. I had you running in Discord. All right. Yeah, I spend a lot of time trying to get the sound just right. It might be, maybe I have to boost it a little bit. Let's try that. We'll boost it. Testing. See, I'm peaking right now. Testing. There's testing. There, that's a little bit more peaked. Tell me if that sounds good, or if I'm blowing your ears out. All right. Yeah, I'll show you that. This is kind of cool. Yeah. So here's the soundboard. There's this microphone. I have all these other microphones going. Oh, a few other microphones going at the same time. But you can see when I talk loud that it peaks. It peaks. All right. So tell me if that sounds okay. That is worse. No, it was my fault. A little loud now. All right. So we'll back it off. All right. So now I'm backing it off, backing off. Is that better? Testing. 1, 2, 3. Testing. Okay. Now I think I have it dialed in. All right. Little diversion there. So now we'll go to this risk of ruin. So what I did was I wrote this this program. It's a Monte Carlo simulation analysis, and it will run this script here, which is essentially simulating our Sigma Drift campaign, and it will run it 5,000 times. Right? Then it will plot out the number of times that, or a graph that will show what the risk of ruin is. And so let me bring up a bigger version of that so we can talk about that. Preview. There it is. All right. So this is the risk of ruin over 5,000 simulations. So what this is saying is that if I started with, I don't know, a smaller account, say a $500 account, my risk of ruin is somewhere around 45%. So in other words, if I could literally start with a $500 account, trade this strategy, and there is about a 1 in 2 chance that I'm going to bust the account. That's, considering that every trade I could make potentially $3,000, $4,000, $5,000, that's pretty cool. But as you go to $1,000, your risk of ruin diminishes dramatically. Now it's only 20%, so 1 out of 5 times. You go to $1,500, and now you're down at about a little under 10%, right? You go to $2,000, now you're starting to get into the single digits. $2,000, and you only have a 4.2% chance of busting the account. All right. You go down to $2,500, and it diminishes even more. Now only under 2%, 1.8%. To $3,000, a little over 1%. And then once you get down to about $4,000, it's essentially zero. All right. So that's really cool. So now I know that if I started with $4,000 and just went through the process of, how you actually trade this system, and I'm going to show you that in a second, which all this Monte Carlo is based on, and explain that. So I know that if I start with $4,000, there's almost a virtual lock that I'm going to make money, right? And obviously, if I go much higher, then the risk goes down even further. But there's some law of diminishing returns. You can see that it just, it will never approach zero, but it will get pretty close to zero. For instance, in a $5,000 account, there's only a 0.06% chance that you could bust your account. All right. So the next thing I'm going to do is I'm going to show you this Monte Carlo analysis and how it works. Just give me a second here. I'm just setting it up. All right. So I have the simulator set up, and let me go over to it so you can see it. So I have both Monte Carlo simulated Monte Carlo analysis. I also have my own empirical evidence. I've traded thousands of trades. So I know what these numbers are, and quite frankly, the Monte Carlo analysis confirms everything I've done in real life. So the way this works is this is the equity curve on the right-hand side of one run. One run would be trading the Sigma Drift campaign over the course of a year. And that means I'm going to do about, if you go over here, I'm starting with $4,000. I start with $70. Each trade that I put on is about $100. So the minimum and maximum risk is $100. All right. And these mod min max and fat min max are the percentages that you'll win, right? And then the range of those wins based on this type of strategy. So what you get is then 3 categories. You get your risk category. That's how much you're going to lose every time. Also includes commissions and all that other stuff. The moderate size wins, they happen. Now the risk size win, the risk happens 87.5% of the time. I want you to consider this. That's saying that you're going to lose about 88% of the time. All right. This is you don't have to look at the strategy. You just know that you're going to lose about 88% of the time. You're going to win about 12% of the time, and that's split up into moderate size wins and what we call fat tail wins. The moderate size wins are around 7.5%. The fat tail wins about 5%. And then we use the min max here to give us the range for those types of wins. And so when you put that all together, they all come out to a net P&L for each trade. So you can see here's the net P&L for each trade, right? And you can see there's a lot of losses. Now, on this particular run, this is the equity curve that results. And at the end, it made 130%, or it ended up, after spending $4,000, it made $9,200. So that's just, it's not saying that that's what's going to happen, but that's just one run. Now, every time I hit calculate now, it's going to do another one. Now, that time it made 171%, or $10,800. That time it ended up being a loss of 32%. Now, that's not a risk of ruin, but it was a loss. And then I'll run it again. This time, 208%. Ended up with $12,000. So I could keep on doing this. Every time I do this is like doing it in another year, right? And one thing that you'll notice is that there are a lot of losing streaks, right? However, the win streaks overall will bring you above. So that's the nature of this campaign, just so you know. We have other campaigns that aren't, quite so dramatic, but you could run, say, 3 of these campaigns simultaneously, and each one is going to be like a separate campaign with its own P&L. So maybe you run one on Mondays, one on Wednesdays, one on Fridays, and then you'll have 6 discretionary trades a month. So you just multiply everything by 3, like they're 3 separate campaigns. And I can show you what that looks like too. But anyways, if you ran this campaign 10,000 times, what would it look like? Well, it would have a distribution of wins that looks something like this, where all the blue bars are winning campaigns. And each blue bar contains hundreds and hundreds of campaigns. And then the x-axis is the size of the win. So you can see there's also red bars, and they represent losses out of that 10,000 runs. But you'll also see that the meat of this up here, right around here, you're the vast majority of the time, if you were to take, just these right up here, you're going to be winning something in the order of 70 to about 200%. So, like, that would be, 50, 60% of the time. Another 30% of the time, you're going to have much larger wins, huge wins. And only approximately 6% of the time, given this strategy and the way I've constructed it, you're going to have about 6% losses, right? So this is an aggressive version of the Sigma drift, a little bit different than the risk of ruin thing I showed you. That one was more conservative. So we trade even more conservative than this. But in other words, you go into this strategy with a small account, $4,000, and there's a damn good chance that you're going to double or triple the account or more, and a very small chance that you're going to bust it. Well, and these aren't even bust. These are, some percentage of loss. Now, it does go up to 100%. Here's the 100%. That's 18 times out of 10,000 tries. So that's pretty small, 0.018%, which is very close to what we saw on that first chart, the risk of ruin chart. But most of the time, you're going to win. So that's how you figure out, how do I go about employing a campaign. I want to know what happens if I were to apply this strategy over time, and what happens if I start with a certain amount of money. Now, on the 0DTE, it's very similar. In fact, I have empirical evidence that I used. Let me see if I can grab that. And because someone asked me this a few years ago. Risk of ruin. I'll see if I can find it for you. Ah, yes. Okay. So I have to switch screens here. So someone asked me this a while back, and I replied to him. This was June of 2023. And I'm referring to a campaign that I ran, and I kept stats on it. and what was the probability of loss, depending on where I started from. And it's all based on how much money I had and, what happened. And then from the way I conducted that campaign, I then ran it through a Monte Carlo simulation. And of course, the campaign was successful, but it's very similar to what we saw there. And it's a little bit more aggressive, and it's a 0 DTE campaign. But what it's saying is that if I started with $2,000, there was about a 1/3 chance that I was going to bust that account. If I start with $3,000, then there's about a 1 in 5 chance, 4,000 about a 1 in 10, and then 5,000 and above, I think it's actually much less than this, 2 to 3%. So that campaign, I'll show you what that campaign looks like. We have to go to Excel. And it's not actually this one, but I have to find that campaign. There it is. So that risk of ruin analysis was done on this campaign. And I've shown this before. All right. So here's that campaign, the empirical evidence that Monte Carlo simulation was based on how I actually traded it, real results. And you can see that this is a really good campaign, very good performance over time. And if you traded this campaign, which is really based on our regular 0 DTE methodology, and assuming that you've become skilled in putting these trades on, you understand the philosophy, you understand market profile, you understand all those things, and apply the strategy, then you'll get this kind of performance. Yeah, I'm not suggesting that you're going to get exactly what I did, because my Sharpe ratio is a little bit extraordinary. But you could have a Sharpe ratio around 3, 2.5, 3, and you're still going to see fantastic performance. In any event, a strategy like this, there's the biggest drawdown that I got through this entire campaign was about 6%. Now, I don't know exactly how much that was, but we could probably find out. So where's the draw? Here's the drawdown column. I can find out where that really big loss was, or series of losses that ended up being about 5.99%. So there's one, 5.2%. So in a $33,000 account, that was about, it wasn't really that much. Let's see if I can find 5.61. So 34, and then I started from 0. 36.5, and then, so about $2,000 off of a $35,000 account, approximately. I think there was one other case where I maybe reached 5.9%. Here it is, right here. So at that point, I went down to $42,000, but I started at $44,600. So about $2,600 of drawdown in that size of an account. Now that's very small. Most pro traders are looking for somewhere between, well, anything 10% or under for a pro trader is considered the gold standard for a drawdown. So anyways, trading this account over that period of time, as I said, and going back to my analysis of that. And now I started with considerably more money, but I was still you can think of when you're starting an account, well, what is the minimum size that I can start with? What is the risk of ruin and that I can start with? And I feel comfortable with, say, a 0.1% risk of ruin if I start with, say, $4,000, and then I trade. and then you build the account, build, and so forth. So let me... Right. Now, of course, if you start with a little bit more money, then your risk of ruin is even less. And part of what will improve your risk of ruin, obviously, is the skills that you attain, the routine you develop, the continuous improvement process that you put in place that is continually on a weekly basis keeping you in check. And that's all part of the strategy. Now, when you take multiple strategies, one thing that I wanted to show you on that particular strategy, because it's a very fine-grained, every day you do a trade, it tends to be a little bit tighter, right? You know, it's not like going like this. However, you probably noticed that in the Sigma Drift campaign, there is a fair amount of all over the place, but generally it goes up. Now, so what I want to show you is what happens when you take and blend these campaigns. What happens then is that some of the campaigns, while they're losing, the other campaigns are probably winning, and vice versa. And so what ends up happening, even with both of them being, even if they're rough, both of them being relatively rough campaigns, when you combine them to it creates a tighter overall curve. And that's kind of simulating zero DTE strategies, because you're essentially doing things every day, sometimes twice a day. And so the more trades that you have, that will bring you closer to what your real performance is. So in a year, I might do 200 or 300 trades in a zero DTE campaign, maybe more. But on a Sigma Drift campaign, I'm only doing 70. Now, if I extended that out for 3 years and then looked at the equity curve, it would look more, in line. It wouldn't look like it's going all over the place. But what I want to show you is what happens when you combine these campaigns. Okay. So what I did here was I took 3 Sigma Drift campaigns. They're all going to be run at different times. One, let's just assume one on Monday, one on Wednesday, one on Friday. They will have different outlooks. They'll all start with the same amount of capital. Other than that, everything's the same. But they'll have different results because they're going to be looking at different ranges of potential profit, and some will grab really good profit. Some might get a pin trade while the others don't get the pin trade, etc. So here's the result of those three campaigns, top, middle, bottom. Now, you see one of them had really good performance. One of them was relatively flat, and another also kind of flat, but a big, long losing streak. But when you combine all 3 of them, here's the combined strategy. It starts looking like my zero DTE campaign, where everything is really tight and just moving up. So that's the power of taking and layering and blending multiple campaigns. Now, you'll even get a better result when you blend a 5 to 10 day DTE with a 3 to 5 and a 0 DTE strategy. When you blend them all together, you get a nice, smooth account. In fact, it will look even better. But the thing is, each account deserves its own cadence and strategy and management. So I wouldn't recommend just going in and just trading a whole bunch of different things. It's like going to online poker and thinking that you could put 5 blackjack, or not blackjack, but Texas Hold'em tables up there and play them all at once and be a winner, and play equally as well on all of them. You need to develop skill in order to do that. So I'm just going back to the big head, bring people back in here. All right. All right, so hopefully this has been informative for you. Where I'm basically showing you how I figure out whether or not a campaign has efficacy that I'm going to be able to maintain. Now, I've been working with these campaigns for decades, so I know what they will do and how they will perform, but I also know what it will take to get there. And that's basically what my service is about. My service as a coach is to help you develop that pro-level skill and to be able to trade these. A lot of people discount that, retail traders. They think that it's all about the strategy. The strategy is important, and it's important that you have one that has convexity. That means small risk, large potential reward, so that you have a positive, right-leaning or right-skewed distribution of returns. That means that all your losses are super small, and your wins can be any spectrum from small to very large. Now, a strategy like that is very easy to scale because you only have to crank up the risk because the losses are very small. That's your risk. You crank that up a little bit, and then that explodes your potential. And that's a relatively low win rate strategy. You saw the worst case one that I had. You only win 12% of the time, but it is a killer. Like out of a 10,000 run, it wins 96% or 94% of the time, and the wins are spectacular. You look at the 0 DTE. I regularly return on a relatively, any kind of account. It doesn't matter if it's $25,000 or $100,000. I'm returning anywhere from, say, 2 to 12% a month. Now, that might not sound exciting, and I'm sure that there are plenty of other YouTubers out there that will tell you that, oh, you can do that in a day. And that's great, but you're taking unbelievable risk. And I'm sure you've been there. This way of trading is exactly the opposite. Your risk is so small. You're never anxious. You can sleep at night. You never really feel pulled or tugged on this, or that you're going towards a risk of ruin. You never feel that way. So it's a lot easier to control your emotions when you know that there isn't a lot of harm ahead of you, but nothing but potential good. And so that allows you to make good decisions. You're logical and rational. I mean, isn't that the way you'd like to trade? That's kind of a rhetorical question. Most other momentum traders or people that are showing you high win rate strategies are exactly the opposite. Because you have to take those big risks, you have what's called a left-skewed negative distribution of returns. That means that all of your positive returns are all very small. They're capped. But your risk is very large. So you can have anywhere from a small to a very large loss. And even if it's a 90% win rate, there's nothing saying that in a 90% win rate strategy that you can't lose 2 or 3 times in a row. And if that happens, that's where people bust their account. And it also results in, overall, a much greater volatility in your returns. So you get these big peaks and troughs like this. And typically, they don't always come right back up to where your last high point is. It almost seems like you can never reach that high point again. And then it just keeps on dwindling off as your psyche starts going nuts on you, and you FOMO trade. You trade out of fear. You're trying to do revenge trading or whatever it is. You're doubling down when you shouldn't, and so now you're not being logical and rational. So that's the problem with high win rate trades. So getting back to what we're talking about, if you want to maintain and understand your risk of ruin and how much money that you can put into an account, we can figure all that out based on the strategy that you choose. I know with a high win rate strategy, your risk of ruin is almost certain. That's just the way it is. It's the reason why most people lose, because they're pursuing high win rate strategies that have tremendous back-end risk, where these strategies have virtually no risk or very, very small risk. There's no way to say no risk, but very, very small risk and large potential. And so you also have another thing that I mentioned, which is should figure into the risk of ruin, and that is your mental state. If you're in a strategy that's always keeping you stressed and you're constantly focusing on risk management, your mental state is going to be relatively poor, right? If you're focusing on a positive expectancy and relatively low win rate, but very, very small drawdown and tight returns, then your mental state is much better. You know what the risk of ruin is, and it's very, very low, where over here, it's almost a certainty. So when you have, and you're never managing risk, because the risk itself is built into the strategy, it's defined. Instead, you're focusing on managing the profit. Completely different mindset, focusing on managing risk, focusing on managing profit. Absolute certainty of a failure if you trade it long enough, absolute certainty of a win if you trade it long enough. So, let's see. Michael Young has a question. Regarding the Sigma Drift strategy, do you employ active profit management or let the trade go to expiration? Active profit management, because consider this. You put on a trade that's 5 or 10 days out, and even if the market was slowly moving towards profitability, your butterfly, it's also premium is decaying, and so that the break-evens are also moving away from you. They're slowly coming into the butterfly, and you're kind of chasing it. But markets don't move that way. They kind of move like this: up, down, big move. It's those big moves that you're really interested in. Now, when is it going to happen? Is it going to happen on the first day or the 10th day? You don't know. But you're a little bit opportunistic. So when those bigger moves, or maybe 2 or 3 big moves in a week, or whatever it is, whatever combination gets you closer near the profitable area, you become opportunistic, and then you take the win. Now, sometimes you'll go and try to constantly catch up on it. Day 1, 2, 3, 4, 5, and then all of a sudden on day 8, you've got 1 day left on the trade. You get a big move, and it goes right inside the profit tent. That's fantastic, because now there's already been a lot of premium decay. You're probably sitting there with a, $2,500, $3,000 winner. You have to make the choice. Do I hang out here for another day and risk losing it all, or do I take the trade? So that's generally how it goes. You have to be opportunistic, and that works out well. All right, JC. Hey, Coach, what's the difference if the price gets toward our fly the beginning or the end of the day? Well, see, that's one of the great things about trading this way and the really out-of-the-money flies. When you trade super wide, they tend to have a lot of gamma. In other words, their profit curve, when you get into the trade, already has a lot of decay and a lot of potential. And the break-evens are much wider than, say, a narrower fly. So it gives you a much larger zone of opportunity. And what is it if price gets towards our fly in the beginning of the day? So wider flies in general are better. Now, I've done a study, and I don't know, is there enough time to show the study? I can show the study. Let's see if I can get to that. That is in the strategy channel. So this study that I'm going to show you is something I did. Oh man, I can't remember when I did it. It was a long time ago. But I was examining the rate of decay in a butterfly at the center strikes at various times during the day. So your question was, well, what happens if it gets into the profit tent very early in the day? And, is the width, now I would add to that, is the width of the trade going to make a difference? That's the real question. So a lot of people think, oh, I just want to get closer to the trade, and so I'm going to put a narrow fly on, and that will allow me to get closer. The problem is, now this is a study that was done when the VIX was around 22 to 23 or so. And I measured the amount of value of the butterfly right at the center strikes at half-hour intervals throughout the day for different width flies. So you can see the first one, the 10 wide, it cost me $1.15 to get in, assuming that it was a 1 to 7 risk to reward ratio. And you'll see that it did not show any value at the center strike until it was around 1 o'clock in the afternoon. Right? And then it increased, and the total increase at 3 o'clock was still only 70% of the original value, what I paid, $115. Right? Now, a 15 wide was a little better because it started to show value and decay sooner, and the overall return as a percent of the risk that I took was much better as well, 213%. But you'll notice that as I go further and further up, the better it gets. So wider, even though it's further out, ends up performing way better for the price that I'm paying for it. Right? And you'll see in here, the 35 wide, I am way out of the money, but it already has significant premium inside the tent. So if I moved into that tent, I would be making a lot more money. And the overall return at 3 o'clock is much more than any of these others. This chart here down below is showing the difference in return by width. And this is showing the rate of premium decay and premium accumulation or profit accumulation by width. And you can see as you go wider, not only is it greater magnitude, but the rate at which it gets up to that larger amount is much faster. So overall, I would say what you want to do is don't skimp on the width. A narrower fly may look better because you'll be closer to price, and it might feel like you're gaming the system, but the wider fly is going to pay better in every case. The wider fly is going to pay better. There's limits to what you can do, and we have that all figured out based on our playbook and our VIX chart, that there are limits because of the rate of decay and where the level of the VIX is. So when you're in a very low VIX, you should stick to a certain narrower type fly, but not 10 or 15. That's way too narrow. And when there's higher levels of volatility, you go to much wider ones. All right. Let's see if I can... hopefully that answered your question. Yeah, like right now, let me show you what our playbook looks like for the VIX. So here's our playbook. This is the volatility index. And you can see that I've broken up the VIX into 3 main areas. Below 17, between 17 and 32, and above 32. I call them Zombieland, Goldilocks Zone, and Chaos. And then over here on the left, you see this is our playbook on how wide we should make our flies depending on where volatility is. And this is all determined based on the optionality and the rate of decay that we're experiencing. What is the optimal width to put it for this type of 0 DTE trade? So 20 to 30 wide when you're in super low volatility, and then as volatility goes up, you go wider and wider. All right, let's see. All right, so hopefully that answers everybody's questions. I don't know if anybody has any other questions. If you do, ask them now. Otherwise, I think that this has been a good show, because now and look, if you need this kind of help and you want to know for certainty what your strategy, if you execute it properly, what it will perform and what your risk of ruin is, that's what you want to do. You want to figure out, if I perform the way it's meant to be traded, I should get X. The problem is that most people look at win rate and think that, oh, that's the only thing I have to look at. And yeah, but I've got stops and I'm managing the stops. But how many of you actually manage those stops when you've had a few losses in a row, and now you're thinking, man, I've got to widen up that stop, or you take the stop off. It happens to everybody virtually all the time. And that's what happens. All right. I want to thank everybody very much. Oh, by the way, we are switching to a 3-day format for the Final Hour show. So it'll be Monday, Wednesday, and Friday. And look forward to seeing you at the next one. This is Coach Ernie, and I am out. Don't forget to hit that like button. Hit that like button.